There are so many investment products out there: retirement annuities, tax-free savings accounts, mutual funds, so many. But in this video, I want to focus on unit trusts. So I'll be talking about what unit trusts are, how they work, the fees and charges associated with them, and some of the pros and cons you might want to keep in mind if you are considering investing in a unit trust. So if this is your very first time here, thank you so much for clicking on this video. My name is Tando and I talk about all things personal finance right here at Small Steps to Freedom to help you take small steps towards taking control of your own money. So if you're ready to learn more about other investment products as well, such as tax-free savings accounts that we've covered in the past, as well as retirement annuities, be sure to hit the subscribe button for all our other content, because we have a video out for you every single Wednesday, so be sure to catch all that action. And for everyone else who's a returning subscriber, thank you so much for coming back. Sit back, relax, let's get into the video. So what are unit trusts? So unit trusts are an investment product created by investment management companies or fund management companies. And what they do is they pull together funds from thousands of investors or a lot of investors and take that money and buy different assets. And then these assets create what we call an investment portfolio. That investment portfolio is then divided up into different units that they then sell to their investors. So depending on how much money each investor is putting in, that will determine how many units they get in that investment portfolio. The cost of the unit trust, or the cost of investing in the unit trust, is dependent on the value of the underlying assets in the unit trust, so the assets that the investment managers actually go out and buy. So as I already stated, unit trusts are actively managed by fund managers, and these are the people who actually go out and decide what to actually invest in at a certain point. So they obviously have a variety of things to actually choose from. So they can choose from equities, property, bonds, and even cash. And the whole point is for them to actually pick investments that will meet the objective or whatever unit trust that is. But you can actually find unit trusts that are focused on one asset class. You can find a property unit trust or an equity unit trust, for example. So what are some of the fees and charges that you can expect to be charged on a unit trust? So these fees can be categorized into two categories. So there's upfront fees as well as ongoing fees. So the upfront fees include your investment management company initial fee, and then you also have your financial advisor fee, and on top of those two you also have VAT, which is also charged separately as upfront fees. On your ongoing fees, you have your financial advisor fees, as well as your investment company management fee, as well as platform management fees. So those are three fees that are ongoing, and those are charged as a percentage of the value of your investment. So if your unit trust is worth 100,000 rands, you might be charged 2-3% of that as an ongoing fee, and that is actually charged on a month-to-month basis. And the 3% is really just a number I'm making up to just explain the point. It's definitely not the set fee that you'll find with every unit trust. These fees do differ between investment companies and different unit trusts in general. And that actually reminds me as well, please do remember that I'm not a professional financial advisor, so all I'm saying is just educational. It's definitely not financial advice, so be sure to do your own research before actually deciding on whether unit trusts are actually right for you. So what are some of the pros and cons of investing in a unit trust? Let's start with the pros. First of all, you do get a really diversified portfolio. As I said in the beginning, unit trust managers can invest in a variety of different assets such as property, equities, cash, bonds. That then gives you a lot of variety within your portfolio so that you're not always exposed to just one asset at a time, so that you're not dependent on just that performance. So if you have property and equities in your portfolio, then if equities are not performing that well, then property might be doing well, so it actually lifts up the entire portfolio's worth. or the other way around. So you always want to be as diversified as possible. And then the second pro is that it is actually professionally managed by professional fund managers. So these are people who've gone to school, who've studied for this, who know what they are doing, who know what they're talking about when they talk about investments and assets and all those things. So it takes away the burden of you having to actually research these things and understand exactly what's happening, although you still want to make sure you know what these assets are and how they perform and how to analyze them to a certain level. Fund managers have to understand it in a much deeper level than the everyday person out there. And then the third pro of unit trust is that there's a pretty low barrier to entry. So you can find unit trusts where you just need 250 rands to actually start investing a month, or 500 rands even. It opens up unit trusts to a lot more potential investors who may not have the thousands of millions of rands to invest, but have the 500 rands to invest every single month, and can also maybe start benefiting from the professional fund management aspect of it that you may not always have access to if you do not have a lot of money to invest. So let's move on to some of the downsides. So some of the downsides of the unit trust is that, one, the fees. The fees can really add up over time, and as you've seen, the fees that I mentioned with ongoing fees and upfront fees. So you do want to consider if those fees will actually be worth the investment, or if you will actually make a profit after that. Even though you can't predict it, you have to try to do your research, understand how the unit trust works, so you make sure that it doesn't eat away at your profits too much. Then the second con, and this is also on the pros list, but can also be a con, is that they're actively managed. And as we all know, no one can beat the market. And I say this in the light of course, fund managers have a lot more knowledge than most people, and they've studied for this and they know what they're doing. But at the same time, it is very hard for them to predict what assets are going to perform the best in the long term, or what specific shares to buy or properties to buy, companies to invest in that will perform the best in the long term. And historically speaking, the JSE Top 40 index, for example, has performed better than most unit trusts. I think only 4 or 5 have actually outperformed the JSE Top 40. So it's really important for you to consider all that when you're actually making your investment. So like any other investment product, you do need to do your research to understand exactly how it works, the pros and cons, and also actually take your own financial situation into account to make sure if it actually even aligns with your goals, if it will help you actually meet your goals at the end of the day, because that's what's most important. So what we did speak about in this video is what unit trusts are, how they work, the pros, the cons, as well as the fees and charges that you can expect to be charged on them. But anyway guys, I really hope that this video actually helped you to understand unit trusts a little bit better, and maybe even pivoted you into doing a little bit more of your own research before you put your hard-earned money into that. And until I see you on my next video, this is bye for now.